Welcome, esteemed viewers, to another enlightening episode on the Deep Dive into Finance channel. Today, we're going to delve into a topic that's crucial to understanding the world of finance: liquidity. It's a term that's thrown around quite a bit, but what does it really mean? And why is it so important? Whether you're just starting your journey into financial literacy or you're a seasoned professional looking to brush up on the basics, this video is for you. We'll start by defining liquidity, then take a look at how it works in the real world. We'll also explore the advantages and potential pitfalls of liquidity, giving you a comprehensive understanding of this fundamental concept. By the end, you'll be able to confidently navigate conversations about liquidity and make informed decisions about your own financial future. So stay tuned as we unravel the concept of liquidity and its significance in the financial world. Dive right into the heart of today's topic: liquidity. So what exactly is liquidity? In the simplest terms, liquidity refers to how quickly and easily an asset, like a stock, bond, or property, can be converted into cash without affecting its market price. To better understand this concept, let's use an analogy. Think of liquidity as a bustling city highway. When traffic is flowing smoothly, cars, or in our case assets, can move swiftly and reach their destinations, conversion into cash, quickly. This is the equivalent of a liquid market, where transactions can happen rapidly without causing significant price changes. On the other hand, when there are roadblocks or heavy traffic, cars move slowly, and reaching the destination takes longer. This mirrors an illiquid market, where selling assets can be challenging, time-consuming, and may even force a drop in price to attract buyers. So, in essence, a liquid market is like a clear, open road, allowing for the easy and quick conversion of assets into cash. In contrast, an illiquid market is like a traffic-jammed road, where selling assets takes longer and may impact their market value. Liquidity isn't just confined to individual assets, it also applies to entire markets. A market is said to be liquid if there are enough participants and the volume of transactions is high. This means that buyers and sellers can quickly execute trades at stable prices. A less liquid market has fewer participants and lower transaction volumes, leading to potential price volatility as buyers and sellers struggle to find common ground. Remember, liquidity is a crucial aspect of finance because it determines how easily you can cash out of an investment. It's like having an exit strategy when you're driving on the highway. You'd want the freedom to get off at the next exit, rather than being stuck in traffic with no end in sight. Having understood what liquidity means, it's time to explore how it works. Now let's delve into the dynamics of liquidity in the financial markets. Liquidity, at its core, is about the ease of trading assets. It's like a bustling marketplace, with buyers and sellers constantly exchanging goods. In financial markets, these goods are assets like stocks, bonds, commodities, and more. It's a dance of supply and demand, where the number of willing buyers and sellers at any given time dictates the market's liquidity. Think about it this way. Imagine you're at an auction, and you're trying to sell a rare painting. If there are many interested buyers, you'll likely sell it quickly and for a good price. This is similar to a liquid market, where there's a high volume of trading activity. The asset, in this case your painting, can be sold easily without affecting its price significantly. On the other hand, if there are few buyers interested in your painting, you might have to lower the price to make it more attractive, or wait longer to find a buyer. This mirrors an illiquid market, where trading volume is low. Selling an asset can be more challenging and might influence its price substantially. Market conditions play a significant role in liquidity too. In a stable economy with positive investor sentiment, markets tend to be more liquid. But in times of economic uncertainty or turmoil, liquidity can dry up as investors become hesitant to trade. The impact of liquidity on asset prices is also crucial. High liquidity usually leads to smaller price changes, as the high volume of trades can absorb large transactions without creating significant price fluctuations. Conversely, in a less liquid market, large trades can cause substantial price swings, creating potential risks or opportunities for investors. In summary, liquidity is a balancing act, influenced by the number of buyers and sellers, market conditions, and its impact on asset prices. Understanding these dynamics can help investors navigate the financial markets more effectively. With a grasp on how liquidity functions, next, we will examine its benefits and drawbacks. Liquidity isn't just a concept, it has real-world advantages that can be harnessed. Now, let's dive into the sea of benefits that liquidity brings to the table, shall we? To begin with, Liquidity promotes ease of transaction. Imagine you're in a bustling marketplace. With liquidity, you're not stuck haggling over a price or waiting for someone to take interest in your goods. Instead, you can quickly and easily exchange your assets for cash. This speed and efficiency is a major advantage, especially for investors who need to respond swiftly to market changes. Next up is price stability. In a liquid market, a large number of transactions occur. This means that the prices of assets are less likely to be subject to wild fluctuations. The price that you see is generally a fair reflection of what the market believes the asset is worth. This gives you confidence that you're not overpaying for an asset or selling it for less than it's worth. Furthermore, liquidity leads to market predictability. In a liquid market, information is quickly incorporated into prices. This means that prices are more likely to reflect the true value of assets, based on all the available information. As a result, it becomes easier for investors to make informed decisions based on accurate price information. But that's not all. Liquidity also enables investors to diversify their portfolios. With a wide array of liquid assets available, investors can spread their investments across various asset classes. This helps to manage risk and can lead to better returns in the long run. And finally, liquidity can boost economic growth. When markets are liquid, capital can flow more easily from investors to companies. This allows companies to fund new projects and expand, which in turn can lead to job creation and economic growth. So there you have it, the many advantages of liquidity, from ease of transaction to economic growth. But remember, every coin has two sides. While liquidity has its benefits, it's not without its challenges. Let's discover what they are. Every coin has two sides, and liquidity in finance is no exception. Just as liquidity can be a boon to the financial markets, it can also have its downsides. Let's delve into the potential pitfalls of liquidity. Firstly, highly liquid markets can be more susceptible to manipulation. This manipulation often comes in the form of high-frequency trading, a practice where traders use sophisticated algorithms to execute large numbers of orders in fractions of a second. These rapid-fire trades can create artificial price movements, which can distort the market and leave retail investors at a disadvantage. Secondly, liquidity can breed volatility. When assets can be bought and sold quickly, their prices can fluctuate wildly, especially in times of economic uncertainty. This volatility can be a double-edged sword. On one hand, it can create opportunities for savvy investors to profit from price swings. On the other hand, it can lead to significant losses for those who aren't prepared for the ride. Now let's flip the coin and consider the challenges of low liquidity conditions. When there are fewer buyers and sellers in the market, it can be hard to execute trades at favorable prices. This is particularly true for large orders, which can move the market significantly when liquidity is thin. In addition, low liquidity can lead to wider bid-ask spreads, making transactions more costly. It can also make it difficult to exit positions quickly, which can be a problem when the market turns against you. Lastly, in extreme cases, low liquidity can lead to market freezes, where trading comes to a halt because there are no buyers or sellers. This can be especially damaging for investors who need to liquidate their positions quickly. Now that we've examined both sides of liquidity, let's wrap up our deep dive. As we come to the end of our journey, let's summarize what we've learned. Liquidity, a fundamental concept in finance, refers to how quickly an asset can be converted into cash without altering its market price. It's a vital cog in the financial machine, enabling seamless transactions and maintaining market stability. We've seen liquidity in action, from the bustling stock market to the quiet corridors of banks, facilitating transactions and ensuring smooth sailing of the economic ship. But it's not all smooth seas, is it? Like all things, liquidity comes with its own set of pros and cons. While it promises ease of transactions and stability, it can also lead to market volatility and the risk of quick, potentially damaging market shifts. In the grand scheme of things, liquidity is a double-edged sword, a balancing act that keeps the financial world spinning. Thank you for joining us on this enlightening journey into the world of finance. Until next time, keep diving deep into knowledge.